This week on the Vancouver Life Real Estate Podcast, we are asking the question that is on many people's minds. How long will the real estate downturn last? The Bank of Montreal just compared today's housing correction to the global financial crisis in the US, and their forecast going forward, it just might surprise you. We are going to break down how far we've fallen and how long it could take before prices potentially recover. Plus, the rental market continues to soften. Incentives for potential renters are piling up, and an increasing amount of investors, well, they're just getting out entirely. In new and updated development news, new projects are slowing, architectural billings are falling, and the Tsawwassen Town Centre proposal just hit another roadblock at council. We'll also talk about Vancouver's bold 0% property tax increase for 2026 and discuss if the city can really afford that. And finally, a record-breaking sale in False Creek has happened. We will take you inside the Tesoro penthouse, the most expensive home ever sold in that area. All that and what it means for the future of Canada's housing market starts right now. Let's take a look. We want to talk first about the downturn, right? It's kind of human nature to look to the past to provide potential insight into what might happen going forward, or at least what will happen this time. In a recent report, the Bank of Montreal Capital Markets compared today's real estate correction to one of the most infamous housing crashes in modern history, the US meltdown of 2007, otherwise known as the global financial crisis, or what resulted from the GFC in regards to housing. In the report, the message is pretty clear. This isn't just a short-term pullback. It is the slow unwind of a full-blown housing bubble. BMO's senior economist, Robert Kavcic, and I'm certainly mispronouncing that, so my apologies, but I think it's Kavcic. Anyway, moving on, he puts it bluntly, quote, "While many are searching for bubbles in the equity market, one continues to undo itself as we speak, Canadian real estate." He explains that bubbles are only truly confirmed in hindsight and after the air has basically already come out. And in his view, that's exactly what's been happening since early 2022. And understandably so, right? I mean, the data looking back now shows that, of course, Canadian real estate, but namely Toronto and Vancouver, did have the most recent peak in 2022. And we are in year 3 of the downward cycle. So here's the reality check. Ontario home prices have now been falling for over 3 years, despite record population growth. And when you chart it out, the decline almost perfectly mirrors the trajectory of the US housing crash that began in 2007. This is where it gets interesting. Now, the comparison doesn't mean Canada's banking system or mortgage structure is about to face the same collapse the US did, right? We've got a bunch of stopgaps in place, but it does mean the correction could last a long time. Kavcic points out that if prices keep tracking in this same pattern or similar pattern, it could take at least another 5 years for Ontario's market to fully recover. And while the US crash was sharper, it also reset the market faster, restoring affordability and rebalancing supply and demand. Canada, on the other hand, is experiencing a slower, more drawn out decline. The chart we are sharing right now shows that it took 5 years from peak to trough for US real estate during the global financial crisis and took 5 more years to return to those peak prices. Ontario in the 1990s was more drawn out. It took 7 years peak to trough, then another 5 years to fully regain prices. That is a 12-year cycle. Today, as mentioned, we're in year 3 of a cycle with no one truly knowing how long it will take to all play out. But here's the key takeaway. BMO doesn't think this kind of boom can happen again, at least not anytime soon. The surge in home prices over the past decade was created by what they're calling the perfect storm, a one-time mix of peak millennial demand, record immigration, ultra-low interest rates, pandemic-era migration, and speculative psychology. All those stars aligned at once to push prices to historic highs. And according to BMO, it's next to impossible to recreate those same conditions. So while many are waiting for a rate cut to reignite the housing market, or another 4 or 5 rate cuts to ignite the housing market, the bank's view is that this recovery won't be quick and it won't be easy. The market still needs time to reset affordability, recalibrate investor expectations, and in some ways, relearn what sustainable housing economics actually looks like. If history tends to repeat itself, we may need another 7 to 9 years from now for prices to return to those pre-downturn peaks.
Really does feel like a structural change, doesn't it, Dan? When you start looking at these cycles, and we don't have the economic prowess that the US has to deploy in order to create that kind of recovery as well. So I'm not quite sure we're going to see that recovery like you mentioned. I think it's going to be very slow. Let's look now at rentals. So if you're looking for a new tenant in Toronto, your offer better be enticing. Right now, 65%, essentially 2/3 of all purpose-built rental projects are offering incentives to would-be renters. Similar sort of to the race to the bottom for prices in the resale market. Landlords have to undercut or provide bigger concessions to attract these tenants. Average asking rents in Canada fell 3.2% in September, down a year earlier, that was $2,123, marking the 12th straight month of annual declines. The latest monthly report from rentals.ca and Urban Nation says asking rents for purpose-built rental apartments were down 2.1% from a year ago to an average of $2,093, while asking rents for condominiums fell 3% to $2,226. Urban Nation president Sean Hildebrand says renters in many regions are seeing the best levels of affordability in 2 years, with those in the most expensive markets of Vancouver and Toronto seeing rents at their lowest levels in nearly 4 years. Asking average rents in Canada were down 1.2% from 2 years ago, making the first 2-year decline since January of 2022. BC and Alberta saw the largest declines in September, with asking rents falling 5.5% year over year to an average of $2,430 a month and $1,734 respectively. Typically, institutional housing providers can outlast your mom and pop investors through these difficult downturns, meaning the likelihood of even more investment properties hitting the market is high. That would extend the downturn that Dan just mentioned even further. What's more, when we look at the mortgage delinquencies, it's important to note that they are not all painted in the same brush. Delinquencies for mortgages with loans above $850,000 at origination are running at double the Canadian average. Those who wrote the variable rates up are likely the vast majority of these, as many Canadians max out their buying power, and we're not ready to see payments double. Bigger mortgage, bigger payment. This is becoming prevalent in Vancouver, where we are seeing the amount of foreclosures in the detached market outpace condos.
So one of the biggest themes that we're seeing start to materialize, and something that we've been talking about for a while, and it's going to continue for the next couple of years, is the future lack of development. It's only, I think, the podcasters like ourselves, I think, that are really kind of discussing this early, and it will hit the major media soon enough. But it's important to kind of get a good understanding of the runway of what's going to happen in the major metros like Vancouver and Toronto 3, 4, 5 years out, as best as we can predict. So when we talk about where real estate and development markets are headed, one of the most reliable early indicators is what's called architectural billings. Think about it this way. Before anything gets built, you need permits. And before you can get permits, you need architects to actually draw the plans. So when architects are busy, it usually means the pipeline of new projects is strong. And when they're not, well, it's an early warning sign of what's coming or what's not coming. Every month, the American Institute of Architects surveys design firms across the country to get a read on activity levels. They ask a simple question: have your billings gone up or down or stayed the same this month? From that, they create what's called the Architectural Billings Index, or ABI. A score of 50 means things are flat, no change from the month before. Above 50 means growth, and obviously below 50 means contraction. So right now, the index is telling a pretty clear story. As of August 2025, billings are down across the US, and not just slightly. The value of design contracts has now declined for 18 consecutive months. That's the longest stretch of weakness since the index was created 15 years ago. Regionally, the South is holding up the best, while the West, well, it's seeing the sharpest declines. The commercial and industrial sectors are showing a bit more resilience, but this is likely helped by all these data center projects that are popping up across the states and continue to be essentially the bright spot for growth. Now, while we don't have identical data for here in Canada, the trends we do know look very similar. Architecture and development firms in markets like Vancouver and Toronto are feeling it Billings are down, projects are being paused, and the layoffs are happening across the board. So ultimately, the takeaway is this. The architectural world often gives us a preview as to what's coming next in construction and development. And right now, that preview is looking quieter than it's been in at least a decade and a half. So pretty telling as to what's going to come. The writing's on the wall as to no future major developments at scale coming to the major metros. And again, in today's landscape, few are going to talk about it because it feels like we have so many homes available, which we do in a sense. But it will be very interesting to watch this play out over the next 3 to 4 or 5 years and what happens should demand come back and supply is low. Time will tell.
I feel like I need to go and get my shoes cleaned by the shoe shiner and figure out what's coming next. Let's move on here and let's discuss the update on the Tsawwassen Town Center application. We mentioned this in a podcast a couple of weeks ago, and there's been new developments here. And while there are fewer and fewer new projects that are being applied for, ones that developers do want to move forward with are being shut down by City Council. An update to the story we talked about previously, which, like I mentioned, the Tsawwassen Town Center Mall project was requested to revise its plan to reduce the amount of new homes it would bring to the area. The new proposal was scaled back, focusing on developing just part of the site with fewer units in a couple of phases, while redevelopment of the rest of the current mall and library, which would remain open, would have been up for discussion and new applications in future years. The revised rezoning plan had 3 shorter towers from 15 to 18 stories, and that was down from the 24 stories that was in the original plan. And that original plan adhered to the site's designations in the new official community plan as well. The new plan also had commercial space, including a larger new Thrifty Foods, as well as a 6,500 square foot space for an urgent or primary medical care facility. The healthcare clinic would have been gifted to the Delta Hospital and Community Health Foundation. However, council members all noted that they would rather see a development plan for the entire site, and they also have doubts whether space for a healthcare clinic was enough of a community amenity, given that there's current doubt the province and Fraser Health are even willing to put one in Delta. At a recent council meeting, Delta's long-debated Tsawwassen Town Center redevelopment took another turn. And while everyone seems to agree the site needs to be redeveloped, the current proposal just isn't there yet. Councillor Dan Boisvert, I hope I said that right, summed it up very well, saying the project in a couple of areas still misses the mark, even though he acknowledges redevelopment is overdue. He said he was disappointed the plan didn't encompass the entire site and added, "I know we're not going to find something that works for everyone. I'm not that naive, but it still needs a little bit more refinement." Boisvert also pointed out a key issue, the lack of a significant community amenity. Right now, the proposal doesn't include one, which many councillors felt was a missed opportunity given the scale of the project. Councillor Rod Binder echoed that sentiment. He noted that while the developer Century Group has a strong reputation and a track record as a community partner, there's still a disconnect between the city's expectations and what's been presented on the table. Binder reminded council that during the creation of the official community plan, he struggled with defining what significant community amenity really means for taller projects. And this, he said, is exactly why that clarity matters. Councillor Jennifer Johal took a more optimistic tone, praising the applicant's efforts and encouraging Century to stick with it and come back with a redefined proposal. Councillor Dylan Kruger added, calling this is the beginning of the conversation, not the end of it. Others, like Councillor Jesse Dosange, emphasized that the site shouldn't be developed in segments, that any redevelopment should take a holistic approach. And finally, Mayor George Harvey acknowledged what seems to be the central theme. The community isn't against redevelopment, but any plans need to reflect the character of Tsawwassen, a farming and seaside community that doesn't expect or necessarily want high-rise towers. Councillor Alicia, I'm not going to be able to pronounce her last name, so I'm just going to call her Elisa G, reinforced that sentiment, saying the new proposal still feels too much and out of scale for the area. So while the redevelopment of Tsawwassen Town Center is inevitable, it's clear the community character, scale, and tangible public benefits are going to be the deciding factors in what eventually gets approved. So this showcases really how challenging it is for projects to move forward, especially in this environment. It is extremely difficult to align developers with city council and with locals who would be impacted. And as of right now, it's entirely unknown if Century Group will be submitting a new application for the future. And I'm largely for, actually, I can see both sides of this conversation. I really can. But I also think, when we're looking at, like you talked about, the lack of architectural billings, development permits dropping off potentially 5 to 7 years, maybe even 10 years before we see the market rebound to a place that, we've seen before. It could, developers could pack up and decide that they're just not going to come back to work here until the conditions are much better or until something's changed with the city as well. So while we would like to see the redevelopment take place, at the same time, we have to be careful that we treat the developers in a way that we don't just shut them out entirely as well. It's got to work for both sides.
Yeah, fully agree. Obviously very nuanced. And keep in mind too, the Burnaby small scale multi-unit housing initiative that had a public, was it like a town hall just this last week, full house, standing room only. They had to stop letting people in because they were at what's considered their fire code maximum amount of attendees. And the results of that will be coming out, I believe, next week or the week after. And of course, we will share that as well. So again, the council had initially passed everything and said, yeah, start going and building homes, missing middle homes. And they were, right? There's upwards of 99 permits that have been issued last I heard. And of course, a bunch of them are under construction today. And a lot of the locals didn't like what they saw going up. And so they voiced their concerns, and we will see what is amended moving forward here and share that with you. Now, something else that happened a little closer to us here, Vancouver City Hall, a property tax announcement was just made. Some may look very favorable upon this because Vancouver City Council just made what is considered a pretty bold move, right? They approved, it's done, a 0% property tax increase for 2026. Yeah, that's right. Zero increase at all. It's a significant shift, right? Especially considering that earlier this year, city staff had recommended a hike of 6 to 7% and including a 1% levy for infrastructure renewal. The motion was introduced by the mayor, Mr. Ken Sim, and it narrowly passed council. A few councillors, I don't need to say their names, but they voted against it. But the majority did side with Ken Sim, who called the decision a necessary measure to ease financial pressure on residents and small businesses. Sim framed the move as a gesture of responsibility and relief, saying, quote, families and businesses across Canada are facing growing uncertainty. This motion ensures that the City of Vancouver does its part to ease the burden by finding efficiencies and managing taxpayer dollars more responsibly. Sounds nice. Now, supporters of the motion, including the Canadian Federation of Independent Business, says it's long overdue. The CFIB noted that 72% of small businesses in Vancouver cite taxes and regulatory fees as their biggest challenge. But of course, not everybody is celebrating. Some residents express concern that a 0% increase could mean service cuts. Things like community programs, libraries, or road maintenance may suffer. In response to that, the city emphasized that the 2026 budget will be built around protecting core services, including emergency response, garbage pickup, arts, and cultural grants. The city's statement also stressed that infrastructure renewal won't be sacrificed, saying they'll continue to invest in long-term projects while still holding the line on taxes. All right, business groups like the Downtown Vancouver Business Improvement Association, well, they were happy. They applauded the decision. Its president, Jane Talbot, called it, quote, welcome news, saying it provides much needed stability for Yaletown small businesses still recovering from years of inflation and high costs. Okay, but what does it all mean in practice? Well, in a city that, we are well known for high costs, from housing to parking to business overhead, a 0% tax increase is extremely rare. So politically, it probably comes across as a win for Ken Sim and his ABC majority, signaling that they might have some fiscal restraint after years and years of steep increases. But economically, it raises a fair question, right? Can Vancouver, maintain the same level of service and infrastructure spending without an increased level of revenue? That's what the 2026 budget will have to prove. For now, Vancouver homeowners and small business owners are getting something they haven't had in a long time. And of course, that is the tax break. Now, before we celebrate too much, let's remember the increases over just the past 5 years. Vancouver's average property tax increased a cumulative of about 32% in just the past 5 years, from 2020 to 2025, with significant annual hikes including 7.5% in 2024, 10.7% in 2023, and 6.35% in 2022. Now, it was slightly offset by 2025 at only 3.9, but I mean, we're averaging over 6% per year over the last 5 years. That's high. So again, 0% will become as a welcome change, but you always got to look big picture, because who knows? Maybe it's 12% next year and it's all moot. But for today, I think some people will be happy with that news.
I largely agree. I would venture to say I'm always skeptical, no matter who the politician is, when they make promises and things like that. So I want to see the books. I want to see the math first. But anyhow, let's move on, and let's just finish off the episode here with the record-setting sale in False Creek. There was, in Olympic Village, a record-setting sale this week. It was the penthouse in the recently completed building Tesoro, and it has officially sold. It was considered the crown jewel of False Creek. This full floor waterfront penthouse spans over 5,000 square feet and offers 360-degree views of False Creek, downtown, and the North Shore Mountains. It was listed for $15.5 million and marks the highest sale ever recorded in False Creek, eclipsing the previous sale by a magnitude of 44%. And one last part is we are extremely proud to announce that it was us that sold it, representing the buyer of this absolutely magnificent home. And I think more than anything, and the biggest surprise, is that it was one of you.
That wraps up today's episode. Thank you always for watching and tuning in. We'd love to hear your feedback on what's going on with the development space. Are these lack of permits and architectural buildings and projects being delayed, pushed down, or shut down entirely going to cause future supply issues? Or is it just a natural reset and everything's just playing catch up? Thanks as always for tuning in and listening. We really appreciate you and when you watch and share. So have a great weekend, and we will see you here next week. Bye.